Hello, I'm Russell Minen and welcome to this video. This video will be part 2 of fixed index annuities. This will be a little bit longer than the first part, a little more in depth. But before I get into that, I want to read a short poem about index annuities I found. And being from Iowa and still have family back in Ames, I thought this was a pretty good poem. "'Twas once an agent from Ames that gave clients annuity gains. It isn't his interest, they said, that put them ahead. 'Twas the risk of loss that he tames." So, index annuities are designed to receive some of the stock market gains, but none of the losses. And that's crucial. If you can avoid the losses, you're a long ways ahead. Well, index annuities, they were developed in 1995, first by Keyport Life Insurance Company. I got involved with index annuities soon thereafter. It's a huge innovation in our business and for our clients. I like index annuities. I own index annuities. I market index annuities. I sell index annuities. I think they're just a great financial tool to have. And remember, you receive part of the gains linked to the stock index, but none of the losses. The index gains are linked to indexes such as the Standard & Poor's 500, the Dow Jones Industrial Average, the NASDAQ 100, and even there's a bond index or two that you can take advantage of. So, and remember, your money is never in the stock market. It's a principal protected, contractually guaranteed safe type account. Well, since 1995, there have been about $300 billion of index annuities sold. When they came out in 95, they were slow to start, and the stock market was doing well, and interest rates were higher. So they started slow, but they gained quite a bit of momentum since the 2000, when there's a huge drop, dot-com bubble, and also a huge drop in 2008 with the real estate bubble. There was a lot of people who went to index annuities. I'm going to show a little chart here I've developed about potential gains in the market and protection, and talk a little bit about that. So I'm going to turn around and look at this. I've got up here potential, which underneath it are different type of equities, such as stocks, bonds, MF for mutual funds, REs for real estate. Then there's options and variable annuities. These are all different types of equities where you have potential of good gains, significant gains, but also risk of loss. Then we have protection, places where you can put your money that are protected, where your principal is protected. CDs with banks and savings and loans, money market accounts, traditional savings accounts, and FA is for fixed annuities, just traditional fixed annuities. So we have potential and protection. Usually you have to choose between one of those. But now, with index annuities, you can take the best of both. Where you can receive some of the market gains, some potential, but you still have protection of your principal. And that's where we can put in here, this is an index annuity. And I coined a new word where you had potential and protection. Relative to an index annuity, you have potential. So who are index annuities for? Well, they're for people who like to earn more interest than the CDs and the money markets and the savings and traditional fixed annuities. They would like to earn more interest than that, and they're designed to return more interest than those. But they don't want their money at risk. They're also meant for people who are in or have been in the stock market, and they're maybe getting close to retirement, and they just can't afford another large drop of their account because they don't have time then to make it up. So it's for those people as well. What's really nice about index annuities with some of them, if you take the longer term ones which are available, they'll give you a cash upfront bonus anywhere from 2% to up to 8% cash immediately added to your account. For example, if you had $100,000, they would add up to $8,000 just to kickstart your account. And people like those. Those are nice. Also, one other feature I want to mention on pretty much all annuities and index annuities, they have a penalty-free withdrawal per year of 10%. So that'll be very important on a future video we're going to do on lifetime income riders, this 10% free withdrawal per year. Since there's no fees on your account, no charges ever taken out, they have a penalty for the term you select, similar to a bank CD would have. What I'd like to do now is just look at another chart on the wall here. I'm going to move this board out of the way. And this chart is an actual example of an index annuity with one of the companies we represent, and it compared to the actual S&P 500 during the same period of time. So down below is 1998 to 2012. That's the time period. And we're starting at $100,000 right here. It shows the chart going as low as $70,000, as high as $200,000. So when you start here at $100,000, 1998, with the S&P 500 in the stock market, this is the red line. It goes up for a couple years to $136,000, and then the year 2000 came and drops down all the way down to $78,000. And then we had some good years of gains in the stock market. In the year 2007, it's back up to $145,000. Then we all know what happened in 2008. It drops down to $100,000, basically where they started. And then the last few years we've had some more gains, so the market is at $137,000 here after starting at $100,000. Okay, the green line is the index annuity. It starts at $100,000 in 1998. It goes up here, but not quite as much as the market because you don't get all the gains. But what's crucial here to understand, critical for you to know, is that if you're in an index annuity, when the market tanks like it did here in 2000, the green line, the index annuity, just holds its own, doesn't go down because you get part of the gains, none of the losses. So my left hand is the index annuity, right hand is the market. So when the market goes up, your index annuity goes up, and it's up here at $156,000 before the big drop in the market again. But the index annuity then in 2008 just holds its own, as you can see here. And in the last few years, the market goes back up, well, so does your index annuity. You end up here in the index annuity with $191,000 compared to the S&P 500, $137,000. The blue line is if the market never went up, went straight down for this whole period of time. The index annuity has an underlying minimum guarantee that it will earn money at a certain minimum, so at the end of the same period it'll be $151,000. So now, if you get an index annuity, would your results be the same as this? Well, I doubt it. This is just a certain time period. The market had two significant drops during that period. Will we receive more drops like that? Well, possibly, possibly not. So I will say, though, that this annual reset method, when the gains are recalculated every year, is crucial, which is really important. We've had some clients receive gains of 10% based in their index annuity because the gains were pretty good size in the market. So I hope this helps you understand index annuities. Thanks for watching. Please watch future videos.